Alright, folks, welcome back to Boss Economics World. Today, we're not talking about the Federal Reserve's latest head fake, or the crypto brothers promising to airdrop you a path to enlightenment. No, today we're going on a safari. A financial safari to the heart of southern Africa, to a country that was once the continent's shining star. A place called Botswana. You've probably heard of it. The Switzerland of Africa. The poster child for good governance and resource wealth management. For decades, it was the ultimate success story, a fairy tale written in diamonds. Free healthcare, free university education, even sending students abroad on the state's dime. It was the envy of its neighbors, a stable, prosperous nation built on a foundation of the world's most precious gems. But the year is 2025, and the fairy tale is over. The story has turned into a horror show. Today, outside clinics in Gaborone, the lines aren't for boutique shopping, they're for basic medicine, with patients like Galimus Moshidi, a taxi driver, waiting 8 hours for a prescription that used to take 1. Construction cranes that once dotted the skyline now stand idle, rusting monuments to a bygone era, as companies fire thousands of workers. University students, promised the world, are now threatening to boycott classes because the government's piggy bank has smashed. So, what happened? Did a corrupt dictator take over? Was there a devastating war? No. Something far more modern, far more insidious, and frankly, far more humiliating happened. Botswana was murdered by a laboratory. Its entire economic model, the bedrock of its society, was made obsolete by a bunch of engineers in white coats who figured out how to grow a perfect, sparkly, utterly soulless diamond in a glorified microwave. The De Beers marketing slogan, one of the most successful campaigns in human history, told us a diamond is forever. Well, it turns out forever has an expiration date, and it just passed. Today, we're going to dissect this tragedy, point by surface. Because the story of Botswana isn't just about a small African nation. It's a brutal, cautionary tale for every country, every company, and every investor who has ever put all their eggs in one very shiny, very fragile basket. This is the story of the diamond curse, and it's a preview of the economic disruptions coming for us all. Let's start with the immediate cause, the point of the crisis. The natural diamond market hasn't just softened, it has fallen off a cliff. For a century, the diamond industry was the ultimate monopoly, a masterclass in manufactured scarcity and psychological marketing. De Beers convinced the world that a crystallized piece of carbon, which is not even particularly rare, was the ultimate symbol of love and commitment. They controlled the supply, propped up the price, and created a multi-billion-dollar industry out of thin air. Enter the lab-grown diamond. For years, these were dismissed as cheap knockoffs, the cubic zirconia of the 21st century. But technology is a relentless beast. Today, a lab-grown diamond is chemically, physically, and optically identical to a mined one. A trained gemologist can't tell the difference without specialized equipment. But the price tag? That's where the difference is screamingly obvious. They can be 50 to 80% cheaper. And the market has responded with ruthless efficiency. The data from jewelry insurer Brightco Incorporated is staggering. In 2019, lab-grown gems accounted for a mere 5% of engagement ring purchases in the US, the world's biggest market. By last year, 2024, that number had exploded to almost 50%. That's not a trend, that's a revolution. A complete regime change in consumer preference in just 5 years. Why the sudden shift? 2 key drivers. First, economics. Millennials and Gen Z, burdened with student debt and facing housing crises, are far more pragmatic. Why spend $10,000 on a natural diamond when you can get a bigger, better quality lab-grown one for $3,000 and use the difference for a down payment on a house, or, to eat? The Veblen good effect, where high price signals high quality, has been shattered by a perfectly good, cheaper alternative. Second, ethics and narrative. The younger generation is acutely aware of the blood diamond legacy and the environmental impact of massive open-pit mining. Lab-grown diamonds come with a clean backstory. No conflict, no displaced communities, a fraction of the carbon footprint. They are the ethically sourced, environmentally friendlier choice. The narrative De Beers spent a century building of romance and rarity was hijacked and replaced by a new narrative of intelligence, ethics, and sustainability. This demand-side shock was compounded by a 1-2 punch from the global economy. The collapse of the luxury retail sector in China, once the great hope for diamond market growth, has evaporated a massive source of demand. Xi Jinping's common prosperity drive and a brutal property crisis have put a lid on conspicuous consumption. Simultaneously, lingering US tariffs and trade friction have gummed up the global supply chains that the industry relies on. The result for Botswana is an economic apocalypse. Diamonds account for 80% of its exports and a third of all government revenue. When your only cash machine runs out of money, everything it pays for stops. And now, Anglo American, the parent company, is looking to sell De Beers itself after repeated write-downs. Think about that. The most legendary name in diamonds is being put up for sale like a distressed asset. That's not a red flag, that's a sky full of red fireworks. Now let's zoom out from the diamond market to the surface, the underlying economic structure of Botswana. What happened here wasn't just bad luck. It was the inevitable, textbook conclusion of a phenomenon economists call the resource curse or Dutch disease. The theory is simple. When a country discovers a hugely valuable natural resource, be it oil, gas, or in this case, diamonds, it seems like winning the lottery. But it often leads to economic ruin. Why? 1. It crowds everything else out. The resource sector becomes so profitable that it sucks all the capital, talent, and political attention away from other industries. Why bother building a complex manufacturing base or a robust tech sector when you can just dig shiny rocks out of the ground for a massive profit? The national currency strengthens due to export revenues, making other potential exports like beef or textiles uncompetitive on the global market. This is exactly what happened in Botswana. They've been talking about diversification since 1970. 55 years of talk. That's not a policy, that's a national procrastination hobby. Tourism is a distant second, at 12% of GDP, and everything else is a rounding error. They had half a century to build a modern, diversified economy, but the easy diamond money made them complacent. 2. It creates a fragile social contract. The government, flush with cash from the resource, becomes a benevolent provider rather than a facilitator of a productive economy. Free healthcare, free education, a bloated public sector, these are all wonderful things, but in Botswana, they weren't funded by a broad tax base generated from a dynamic, resilient economy. They were funded by a single, volatile commodity. The citizens become dependent on government largesse, and the government becomes dependent on a hole in the ground. When the price of that commodity collapses, the entire social contract breaks down, as we are seeing now. 3. It inhibits institutional growth. A productive economy requires a skilled workforce, robust property rights, and a culture of innovation. A resource-based economy just requires a shovel. With over 40% of its youth unemployed, Botswana's biggest export was becoming its own educated citizens, because the diamond mines only employ a few thousand people. The largesse papered over the cracks of a non-inclusive growth model. We have seen this movie before, again and again. Look at Venezuela. It has the world's largest oil reserves. In the 1970s, it was the richest country in Latin America. Today, its people are starving. Why? It rode the oil wave up and crashed all the way down, having never built anything else. Look at Nigeria, another oil giant plagued by corruption and a lack of diversification. Look at the tragic case of Nauru, a tiny Pacific island nation that became one of the richest countries per capita in the world in the 1980s from phosphate mining. When the phosphate ran out, the country was left with a ravaged landscape and a bankrupt economy. The truly successful resource nations are the exceptions that prove the rule. Norway, for example, discovered massive oil reserves. But instead of spending it all, they created the world's largest sovereign wealth fund, now worth over $1.6 trillion. They used the resource wealth to invest globally, insulating their domestic economy from oil price volatility and securing prosperity for generations. Botswana did have a sovereign fund, the Pula Fund, but at its peak of around $5 to $6 billion, it was a water pistol against the coming inferno, and now foreign reserves are slumping by 27% in a year. They saved for a rainy day, but they are now in the middle of a biblical flood. So, with their economic model shattered, how is the new government of President Duma Boko responding? They are running the classic politician's playbook of panic, and it's a painful spectacle to watch. Step 1. The Miracle Investment. On August 21, Boko announced a whopping $12 billion investment from a little-known Qatari group, Al Mansour Holdings. Sounds great, right? A savior has arrived. But hold on. A little digging reveals the same group has promised over $100 billion in investments across 6 different African countries in recent weeks. Folks, when something sounds too good to be true, it is. This isn't a credible investment strategy, it's a desperate press release designed to calm a panicked public. It's the political equivalent of thoughts and prayers. Step 2. Raid the last pots of money. On August 25, the president declared a public health emergency. Not just because of the long queues at clinics, but as a pretext to implore pension funds and insurers to help fund the response. Let's translate this from political speak into plain English. We are broke. We are now coming for your retirement savings. This is a classic move of a sovereign in distress, tapping into domestic savings pools when the tax revenues have dried up. It's a short-term fix that jeopardizes the long-term financial security of its citizens. Step 3. The inevitable debt spiral. After decades of prudent borrowing, Botswana is now rushing headlong into the arms of creditors. They've taken $304 million from the African Development Bank, $200 million from the OPEC Fund, and are planning a domestic bond roadshow. The problem is, they are borrowing at the worst possible time. Their credit rating, once the highest in Africa, is under threat. Both Moody's and S&P have cut their outlook to negative. This means future borrowing will be more expensive, creating a vicious cycle. The IMF's forecasts are a horror story. A fiscal deficit of 11% of GDP in 2025, the biggest in sub-Saharan Africa. Government debt is set to double to 43% of GDP in just 2 years, blowing past their own legislative debt ceiling. They are trying to solve a revenue problem by creating a debt crisis. It's like trying to put out a fire with gasoline. As Ravi Bhatia from S&P Global Ratings stated, they are under severe pressure. But the fiscal consolidation and austerity they are attempting now is too little, too late. You can't diet your way out of a famine. The story of Botswana is heartbreaking. But we are not here to pity them. We are here to learn. Because what happened to the diamond industry is a microcosm of the creative destruction that is sweeping across the global economy. As author Charlie Robertson bleakly put it, the difference with the oil cycle is that diamond prices are unlikely to ever come back. This isn't a cyclical downturn, it's a permanent, structural disruption. A technological paradigm shift has rendered their primary asset obsolete as a store of high value. So, what are the lessons for the audience of Boss Economics World? For investors, this is a masterclass in the danger of concentration risk and the existential threat of technological disruption. Your portfolio's biggest vulnerability might not be a market crash, but a breakthrough in a university lab somewhere. Any industry built on artificial scarcity, complex supply chains, or a narrative that can be easily rewritten is a potential diamond. Think about traditional banking versus fintech, fossil fuels versus renewables, commercial real estate in a work-from-home world. The question you must constantly ask is, what is the lab-grown diamond in my industry or my portfolio? For policymakers, Botswana is a warning against the siren song of easy money. True national wealth is not dug from the ground, it is built in the minds of a skilled populace and the resilience of a diversified economy. Investing in education, infrastructure, and a business-friendly environment that fosters innovation is infinitely more valuable than a mountain of glittering stones. And for everyone, the biggest lesson is about the very nature of value. Value is a collective belief system. For 100 years, we believed a tiny piece of carbon was worth 3 months' salary. Now, that belief has been shattered. It shows how quickly and completely a long-held economic truth can be vaporized by a combination of technology and a shift in generational values. Botswana's diamond model is not one of the shining lights on the African continent anymore. It's a black hole, a warning beacon for the rest of us. So, take a hard look at your own assumptions. Take a hard look at what you believe is forever. Because in the 21st century economy, the only thing that is forever is change. And it comes for everyone.